X. Identify the interaction between high inventory turnover and high gross margin. Inventory turnover measures how quickly inventory is sold and replaced. High turnover indicates efficient inventory management and strong sales performance. Gross margin reflects profitability per unit sold. Companies may pursue either high turnover with low margins or lower turnover with high margins. Some businesses, such as discount retailers, operate with low margins but high turnover. Others, such as luxury brands, rely on higher margins with slower turnover. The combination of turnover and margin determines overall profitability. A firm must balance pricing strategy with operational efficiency. Understanding this interaction supports strategic positioning and competitive advantage decisions. Why? Demonstrate understanding of economic order quantity, YOQ. YOQ is the order quantity that minimizes total inventory costs. It balances carrying costs and ordering costs to determine the optimal order size that if carrying costs increase, YOQ decreases. Firms will order smaller quantities more frequently to reduce holding costs that if ordering costs increase, YOQ increases. Larger, less frequent orders reduce administrative expenses. Demand level directly influences YOQ. Higher demand increases optimal order size. YOQ analysis supports cost-efficient inventory management and enhances overall working capital performance. Z. Understand how risk affects current asset financing policy. A company's working capital financing policy reflects its risk tolerance. An aggressive policy finances a significant portion of current assets, and sometimes permanent assets, with short-term debt, reducing financing costs but increasing refinancing and liquidity risk. A conservative policy relies more on long-term financing. This reduces rollover risk and improves liquidity stability but typically increases financing cost. A moderate, matching approach balances risk and return. It aligns asset maturity with financing maturity. Short-term rates are often lower but more volatile. Heavy reliance exposes firms to interest rate fluctuations. Management must balance profitability and liquidity risk when selecting a financing strategy. Identify and describe types of short-term credit. Trade credit is supplier financing allowing delayed payment for purchases. It is spontaneous and widely used in working capital management. Short-term bank loans provide lump sum borrowing with stated maturity and interest. Lines of credit offer flexible borrowing up to a preset limit. Commercial paper is unsecured short-term debt issued by large, creditworthy corporations. Bankers' acceptances are bank-guaranteed time drafts used in international trade. Letters of credit ensure payment to sellers, reducing counterparty risk. Each instrument varies in cost, flexibility, collateral requirements, and risk exposure. BB. Estimate annual cost of not taking a cash discount. Suppliers often offer terms such as 2/10, net 30. Foregoing the discount means paying later but losing the price reduction. The implicit cost equals the discount divided by the net amount paid, annualized over the period between discount date and due date. This cost is often very high on an annualized basis. It may exceed alternative short-term borrowing rates. Managers must compare the effective annual rate, EAR, of not taking the discount with borrowing costs. Rational financial management typically favors taking discounts when the implicit cost exceeds alternative financing rates. CC calculate effective annual interest rate with compensating balances and fees. Compensating balances require borrowers to maintain a minimum deposit, reducing usable loan proceeds. This increases the effective cost of borrowing. Commitment fees may be charged on unused portions of a credit line. These fees must be included in cost calculations. Effective annual rate equals total annual financing cost divided by usable funds. Ignoring compensating balances understates true borrowing cost. Accurate EAR calculation supports informed short-term financing decisions and cost comparison. DD understand factoring and calculate cost of factoring. Factoring involves selling accounts receivable to a third party, factor, at a discount for immediate cash. It improves liquidity and reduces collection risk. Factors may provide credit evaluation and collection services. This reduces administrative burden. The cost of factoring includes the discount fee plus any service charges. It is measured relative to the funds received. Firms compare factoring costs to alternative financing costs. Factoring is beneficial when liquidity is critical or when collection risk is high. Explain maturity matching, hedging approach. The maturity matching principle aligns asset life with financing maturity. Short-term assets are financed with short-term debt, long-term assets with long-term financing. This approach reduces refinancing risk and interest rate exposure. Temporary current assets are financed short-term, while permanent working capital is financed long-term. It balances liquidity and cost efficiency. Maturity matching supports stable financial planning and risk management. FF understand factors in managing working capital costs. Working capital costs include financing costs, carrying costs, and opportunity costs. Efficient management minimizes total cost while maintaining liquidity. Interest rates and credit terms influence financing expenses. Firms must monitor market conditions. Operational efficiency affects receivables, inventory, and payables levels. Risk tolerance shapes policy decisions. Integrated management of cash, receivables, inventory, and payables enhances profitability and financial stability.